It took everything, every spare moment, every sacrifice, to save $5,000. It wasn't just a number, it was the result of countless hours, missed nights out, and selling what I could. That money was the proof I could claw my way out of a financial hole. But with that sum came a new pressure, the fear that one wrong move could wipe it all away. Yet there was also hope, the chance to make it grow into something bigger. This was about more than surviving, it was about building a future and taking control. $5,000, my ticket to the game, my key to a locked door. But the question haunted me, how do I invest it wisely, without making a colossal mistake? Investing felt like stepping into another universe, full of jargon and intimidating charts. The fear of losing everything was real, but I couldn't let it stop me. I devoured blogs, videos, and articles, learning that investing isn't gambling or a get-rich-quick scheme. It's about ownership, buying into companies I believe in and letting my money work for me. The more I learned, the more my fear turned into determination. I was ready to dive in and build something lasting. This wasn't about chasing hot tips or timing the market, it was about building a solid foundation. I created my own investment rules to stay disciplined and protect my hard-earned money. Saving is important, but it's only the first step. Inflation quietly erodes your savings like a slow leak in a tire. To truly grow wealth, you have to move beyond the piggy bank and start investing. Investing shifts you from a scarcity mindset to one of abundance, letting your money work for you, even while you sleep. Inflation is the silent thief that makes your money worth less over time. If your cash just sits in a savings account, it loses value year after year. Investing is how you outpace inflation and generate real returns. Even a modest return can help your money maintain its value. Inflation might be 2% a year, your money needs to grow by at least that much just to keep up. Investing gives your money the chance to grow, not just survive. Compounding is the snowball effect, earning returns on your returns. The longer you invest, the more powerful compounding becomes. Even small, consistent investments can grow into substantial sums over time. Time is your greatest ally. The best time to start was yesterday, the next best is today. Plant the seed now, and let it grow. Investing is about planting seeds for your future and creating financial security. That savings marked my turning point, a commitment to break free from living paycheck to paycheck. It's a journey of informed decisions, discipline, and patience. The rewards, over time, are worth every effort. I remember hovering over the buy button, tempted to go all in. But my first rule was clear: only invest what I could afford to lose. The market is unpredictable, and I needed a safety net. This rule protected me from being wiped out by sudden drops or emergencies. Investing isn't gambling, it's about building a solid foundation. By managing risk, I could weather any storm. The financial world is noisy. Everyone's shouting about the next big thing. Chasing hype is a recipe for disaster. My second rule: tune out the noise and ignore get-rich-quick schemes. Investing is about rational decisions, not emotional reactions to trends. Staying disciplined and sticking to my plan was far more rewarding. Slow and steady wins the race. Investing isn't rocket science, but you need to educate yourself. My third rule: understand what I'm buying. I researched asset classes, risks, and diversification until I felt empowered. Knowledge is power, and the key to confident decisions. My final two rules: diversify and think long-term. Diversification spreads risk. If one investment falters, others can cushion the blow. Investing is a marathon, not a sprint. Patience is essential. These principles gave me peace of mind and kept me focused on my goals. Social media is full of gurus promising overnight riches. I learned to ignore the hype and seek credible sources, reputable websites, financial institutions, and experienced investors. I focused on education and long-term strategies, not flashy promises. The right information made all the difference. Financial jargon was overwhelming at first, but I refused to be intimidated. I used glossaries, took notes, and gradually cracked the code. Understanding terms like stocks, bonds, ETFs, and dividends was empowering. You don't need a finance degree, just curiosity and effort. Investing isn't just about picking stocks, it's about understanding the bigger picture. I learned about asset classes, market cycles, and the relationship between risk and reward. Building a solid foundation of knowledge set me up for smart, informed decisions. With a solid understanding of the basics under my belt, it was time to start thinking about my investment strategy. I knew I wanted a portfolio that was diversified, low-cost, and aligned with my long-term goals. I also knew that I didn't want to be glued to my screen, obsessively tracking every market fluctuation. That's when I stumbled upon the concept of index fund investing. Index funds are a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500. They offer broad market exposure, low fees, and a hands-off approach to investing, making them an ideal choice for beginners. I also learned about the importance of international diversification, which involves investing in assets outside of my home country. This helps to reduce risk by spreading investments across different economies and currencies. With these principles in mind, I began crafting my investment strategy, carefully considering the allocation of my capital across different asset classes and geographies. With my research complete and my investment strategy taking shape, it was time to decide which specific investments would make up my first portfolio. I knew I wanted to start with a strong core, a foundation built on diversification and the potential for long-term growth. That's where the VOO ETF, which tracks the S&P 500 index, came in. The S&P 500 is an index of 500 of the largest publicly traded companies in the United States, representing a broad cross-section of the American economy. By investing in the VOO ETF, I was essentially buying a tiny piece of each of those 500 companies, giving me instant diversification across various sectors and industries. It was like casting a wide net, capturing the growth potential of the overall market. I allocated 50% of my initial capital to the VOO ETF, making it the cornerstone of my portfolio. I like the idea of having a significant portion of my investments rooted in the stability and growth potential of the U.S. economy. This felt like a safe, sensible starting point, providing a solid base upon which to build the rest of my portfolio. While the U.S. stock market is undoubtedly a powerhouse, I knew that limiting myself to a single country would be a mistake. I wanted to diversify my portfolio further by tapping into the growth potential of other economies around the world. That's where the VXUS ETF, which tracks the performance of international stocks, came into play. The VXUS ETF provided exposure to both developed and emerging markets, giving me a truly global reach. I allocated 15% of my portfolio to VXUS, believing that investing in international markets would not only mitigate risk, but also provide access to companies and industries not well represented in the U.S. market. I was particularly interested in the growth potential of emerging markets, which often offer higher growth rates compared to their developed counterparts. While these markets can be more volatile, I believed that their long-term potential outweighed the risks, especially within the context of a well-diversified portfolio. While I was excited about the growth potential of stocks, both domestic and international, I also understood the importance of balancing risk and reward. That's why I decided to allocate a portion of my portfolio to bonds, which are generally considered to be less volatile than stocks. Bonds are essentially loans that investors make to governments or corporations. They typically offer lower returns than stocks but provide a steady stream of income in the form of interest payments. I chose the BND ETF, which tracks the performance of a broad range of U.S. bonds, as my bond investment. I allocated 10% of my portfolio to BND, believing that this allocation would provide a cushion against potential stock market volatility. While I was optimistic about the long-term growth potential of my stock investments, I wanted to ensure that my portfolio could withstand market fluctuations without derailing my overall financial goals. In addition to growth, I was also interested in exploring investments that could generate passive income. That's where dividend stocks, which are stocks that pay out a portion of their profits to shareholders, caught my attention. I was drawn to the idea of receiving regular income from my investments, which could then be reinvested to further accelerate my portfolio's growth. After researching various dividend-paying companies, I decided to invest in the SCHD ETF, which tracks the performance of a portfolio of high-quality dividend-paying U.S. companies. The SCHD ETF focused on companies with a history of paying consistent and increasing dividends, which aligned with my long-term investment strategy. I allocated 15% of my portfolio to SCHD, believing that this allocation would provide a balance between growth potential and income generation. While the dividend yields on SCHD were not as high as some individual dividend stocks, I appreciated the ETF's diversification and its focus on companies with a proven track record of dividend payments. While I was committed to a diversified and balanced approach, I also wanted to reserve a small portion of my portfolio for a more speculative investment, a company I believed had the potential for significant long-term growth. After much deliberation, I settled on Apple, a company I had long admired for its innovation, brand loyalty, and global reach. I understood that investing in individual stocks carried more risk than investing in diversified ETFs, but I was willing to take a calculated risk with a small portion of my portfolio. I believed in Apple's long-term growth potential, especially in those emerging markets where smartphone penetration is still relatively low. So, I allocated 10% of my portfolio to Apple, viewing this investment as a long-term bet on the company's continued success. While I totally acknowledge that past performance is not indicative of future results, I was confident in Apple's ability to adapt, innovate, and remain a dominant force in the technology industry for years to come. Weeks of research had led to this moment. I had my portfolio planned out, my investments carefully chosen, and my budget set. But honestly, there was still a part of me that felt a knot of anxiety as I sat down to actually buy my first investments. It felt surreal, like all those hours poring over charts and articles were about to culminate in this one pivotal action. Choosing a brokerage account felt like a big decision in itself. There were just so many options, each with their own fee structures and features. I wanted something user-friendly, especially as a first-time investor, and with reasonable fees. After comparing a few platforms, I settled on one that really fit my needs. Their interface was clean and intuitive, and they offered fractional shares, which was essential for me since I was starting with a limited budget. Connecting my bank account and initiating the transfer felt like a significant step. It was real now. This money, which I had worked so hard to save, was about to take a leap of faith into the markets. I decided to transfer the funds in smaller chunks just to ease my nerves and to give myself time to get used to the process. One of the biggest misconceptions about investing is that you need a lot of money to get started. While it's true that larger sums can potentially generate larger returns, even small amounts invested consistently can grow significantly over time. The key is to start somewhere, no matter how small. That's where the beauty of fractional shares comes in. Fractional shares allow you to buy portions of a share, rather than having to purchase a whole share up front. This is honestly a game changer for investors with limited capital, because it allows you to invest in companies with high share prices that would otherwise be inaccessible. For example, instead of needing a large amount of money to buy a single share of a company like Amazon, I could buy a fraction of a share with as little as $50. This was incredibly empowering. It meant that I could still build a diversified portfolio even with my limited budget. I could own a piece of companies I believed in, without having to wait years to save up enough money to buy a whole share. It really felt like the doors to investing had been flung open, welcoming me in with open arms. The internet is awash in stories of overnight fortunes made and lost on meme stocks, those companies that capture the attention of social media and experience sudden dramatic price swings. It's easy to get caught up in the frenzy, to feel like you're missing out on the next big thing if you're not riding the wave. But I knew that chasing those quick wins was a dangerous game, one that rarely ended well. My research had taught me that investing was about so much more than following the latest trends or getting caught up in hype cycles. It was about identifying companies with solid fundamentals, strong track records, and long-term growth potential. Meme stocks, on the other hand, were often driven by speculation and emotion, making them incredibly volatile and unpredictable. I had to constantly remind myself that my hard-earned savings wasn't meant to be gambled on the off chance of getting rich quick. It was the foundation of my financial future, and I was determined to treat it with the respect and discipline it deserved. So, I resisted the allure of meme stocks, no matter how tempting they seemed, and stayed focused on my long-term investment strategy. Another rookie mistake I was determined to avoid was trying to time the market. That is, trying to predict the perfect time to buy and sell investments to maximize returns. It sounds tempting in theory, but in reality, it's incredibly difficult, even for seasoned investors. The market is influenced by countless factors, many of them unpredictable, making it nearly impossible to consistently buy low and sell high. Instead of trying to outsmart the market, I embraced the power of patience. I knew that investing was a long-term game, and that short-term market fluctuations were inevitable. I accepted that my portfolio would experience ups and downs, but I remained focused on the bigger picture, trusting that my diversified investments would weather any storms and ultimately trend upwards over time. This patient approach brought a sense of peace of mind that no amount of market timing could replicate. I wasn't constantly checking my portfolio, stressed about every dip and spike. Instead, I was confident in my strategy, knowing that I was in it for the long haul and that time was my greatest ally. Taking that final step, clicking the confirm button to execute my first trades, was both exhilarating and terrifying. It felt like a weight had been lifted, replaced by a mix of anticipation and a quiet sense of accomplishment. I had done it. I had overcome my initial fear, educated myself, and taken control of my financial future. I was officially an investor. Staring at my portfolio, even with its modest balance, filled me with a sense of pride. It wasn't just a collection of stocks and bonds. It was a testament to my journey, my commitment to building a better future for myself. It represented countless hours of research, the discipline to resist impulsive decisions, and the belief that even small steps could lead to significant outcomes. But more than anything, it was a reminder that I wasn't just along for the ride. I wasn't relying on luck or someone else to secure my financial well-being. I was taking an active role in shaping my own destiny, investing in my future one carefully considered decision at a time. It was a feeling of empowerment I had never experienced before. Building my first portfolio was a significant milestone, but I knew it was just the beginning of my investing journey. I had laid the foundation, but now it was time to focus on automating my investments and developing strategies to grow my wealth over time. The goal wasn't just to build a portfolio, it was to create a system that worked for me, one that allowed my money to grow passively while I focused on other aspects of my life. I began exploring the concept of automated investing, setting up regular contributions from my bank account to my brokerage account. This set-it-and-forget-it approach appealed to my desire for a hands-off approach while ensuring that I consistently invested in my portfolio, regardless of market fluctuations. I also set up automatic dividend reinvestment, allowing my dividends to be automatically reinvested into my portfolio, further accelerating my wealth-building efforts. I was eager to learn more about different investment strategies such as dollar-cost averaging and tax-efficient investing. I knew that my investment journey was just beginning, but I felt confident and excited about the road ahead. I had discovered a passion for investing, a desire to not only grow my own wealth, but to share what I had learned with others, empowering them to take control of their financial futures. If you found this video helpful, please like, comment, share, and don't forget to subscribe.